We begin with AMD, perfectly pinned at a spot price of $510.13. This chart graphs that $510 spot price against the 50-day simple moving average. The comparison exposes a stark structural deviation. The underlying asset is trading at a positive 52.6% premium to the macro mean. Operating more than 40% above the moving average forces institutional market participants into defense. At this extreme altitude, quantitative risk models trigger extension protocols, mandating large funds to systematically lock in their gains. This high-altitude trading environment brings friction, massive daily options contract volume, and implied volatility exceeding 80%. The market is pricing in violent movement. Retail traders routinely misinterpret high volume and high implied volatility at the top of a chart as the fuel for a continuous bullish breakout. These specific conditions mathematically signal structural overhead exhaustion. To see how that exhaustion physically manifests, we map the options market's max pain point. This is the precise strike price where the highest number of options contracts expire worthless. It operates as a liquidity gravity well, designed to punish the maximum number of buyers. This data visualizes the options flow for early June. The highly concentrated max pain anchor formed directly at the $510 strike. Tracking into late June, the max pain node systematically migrates downward to the $500 strike, accompanied by an imbalance of put open interest. The spot price of the underlying asset refused to drop, yet the options market systematically dragged its own center of gravity downward by a full $10. Dealer delta neutrality requirements engineer this manufactured reversion, shifting the options market's anchor point even while the spot price remains stagnant. If we isolate the early June options flow data, we can see exactly how the upside is blocked. We examine the strikes directly above the 510 spot price. The 520 strike contains 35,100 call contracts. Compare that to the microscopic put open interest of just 5,400 contracts. This creates a towering vertical wall of call resistance. The extreme implied volatility conditions harden this barrier, establishing a strict volatility ceiling. Any upward volume velocity attempting to push through this strike is immediately absorbed. Market makers holding the other side of those call contracts must continually shed their call delta to neutralize exposure as the price rises. Structural overhead exhaustion at the ceiling strike makes an upside gamma squeeze mechanically improbable. With the upside firmly blocked, the focus narrows directly back to the 510 pivot point, where the asset is pinned. This specific strike serves as the gamma flip zone. It is the razor-thin boundary line where market maker exposure shifts violently from positive to negative. Just below this line, a heavy, asymmetrical cluster of put open interest is building between $510 and the $500 floor. Because we are analyzing 0-day and 1-day to expiration cycles, the impact of this specific put skew is vastly magnified. The extrinsic value of these near-term contracts, known as theta, decays at a hyper-accelerated rate over the course of the daily trading session. That decay acts as a strict timer. If the spot price slips even slightly below the $510 pivot, the hedging mechanics invert. This logic flow tracks the negative gamma loop. As puts decay, dealers must sell underlying shares into the bid to remain delta neutral, a process that exerts heavy mechanical pressure on the spot price. The intense 0-day time decay, combined with that massive asymmetrical put skew, ensures the $510 pivot does not act as support. Instead, it essentially functions as a structural trapdoor. Pulling back to the macro view, we return to that 52.6% deviation from the 50-day moving average at the opening bell. Institutional players and market makers recognize this severe structural detachment. They utilize the surge of early morning retail liquidity purely as an exit opportunity. This executes as a gap and fade. Large market participants systematically distribute their delta exposure into the opening retail momentum, shedding their long positions at the top. The options flow logs from June 5th quantify this distribution. We see the put open interest at the $500 floor rapidly inflate to 38,200 contracts as the smart money positions for the drop. This institutional distribution provides the deliberate spark. It pushes the price just far enough off the pivot to ignite the market maker's negative gamma feedback loop. Fast forwarding to the mid-June monthly options expirations, the culmination of these mechanics becomes visible. Aggressive structural downside protection is now permanently priced in under the 25 delta put wing. The broader market is fully hedged for a drop. Looking at the far right of this chart, the shift in SMA distance clearly correlates with the cemented $500 max pain floor. The options chain has completely absorbed all overhead liquidity. The underlying asset operates in a state of strict volatility compression, shedding call delta at the ceiling while shorting into the floor side put skew generates a sustained reversion drag toward the max pain node. The mathematics exert intense downward pressure. Stripped of its upward momentum, the underlying asset collapses into the structural floor wall. In historically overextended conditions, options flow does not generate breakout velocity. It mechanizes a reversion drag, governed strictly by the requirements of dealer delta neutrality.